So let's take a look at a couple of squeeze examples here, and then we'll get into some back trading, and we'll actually work through the squeeze play setups here. But take a look at this chart of the Dow. Notice how the squeeze started to come into contraction here. Now it's very visible from the Bollinger Bands, and it's also very identifiable from the bandwidth indicator here. If you look back several months, you don't see any bandwidth indications that are this low. And so you know this is a squeeze. You know that the probabilities are very high that when this breaks, it's going to be an explosive move, and it's probably going to establish at least a good-sized swing, if not a full-blown trend in a direction. Now, you don't necessarily know which direction. In this case, it broke bearish here. Let's look for the signals we were looking for. We said a close outside the band, and we got that right there. So your entry would be the next day, where it just continues in that direction. You're also going to notice with your percent B, you're oversold. You're always going to be oversold on a squeeze breakout like this. If it's a bearish breakout, if it's a bullish breakout, you'd be overbought. But with this one, it's bearish, so it's going to be oversold. The reason, remember, percent B tells you where you are relative to the band. So if you're oversold, if you're beyond 0 in this case, you know you're below the band. If you're above 1, you know you're above the band. So it's going to be looking like it's extremely overbought. Most people think that that's a reason to, in this case, buy it, but it's actually the opposite. It's a signal of bearish weakness or bearish, strength into the bearish trade here. And so you want to be selling that, either selling it short, buying puts, doing something to trigger into the bearish trade here. So there's your first example of the squeeze and everything else working with it here. Look on the right side of the chart. You're going to see the same kind of setup here. The squeeze visually, very obvious on the Bollingers itself. The bandwidth indication is very low. Look back several months here. The previous one was about 6 months before. That's the one we had just looked at. And of course, again, you're very oversold in your percent B. You had the first close below the bands here. You entered the trade the next day. And, here we were, 7 or 8 days later, 700, 800 points to the downside on the Dow Jones Industrial Average. So there's a couple of examples. Let's look at some more. Let's look at one here on First Solar. Again, another bearish trade example. You see we had the squeeze set up right here, very visually obvious on the bands. You look at your bandwidth, very low reading. And if you look at your percent B, of course, you're extremely oversold because you're pushing outside the bands there. You have the close outside the band. Now, this one is a little different, but it's very typical. You actually had several trading sessions here, 1, 2, 3, 4, 5, 6 sessions before it really started making bearish progress. So you actually had about 6 opportunities to enter this trade and not lose any of your real profit. Now, this could scare some people. Some people might start to think, well, the trade is not going to work. You need to go with it, set your parabolic stop in there, and trust it until you see the head fake, until you have a reason to not take it. Trust the trade and just go with it. And of course, it did come up here and eventually broke on bearish. We ended up getting in this trade about, $67 a share. And where you started getting your exit signals were down here around $50 a share. So that's a $15 to $17 per share profit in just a couple weeks. Very, very quick trade there with First Solar. Now, I've not got it marked on the chart, but I do have another one over here as well. This one, take a look at this squeeze here in February. The bandwidth was not as low, so it was a lower probability squeeze, but it still worked out just perfect. You see your bandwidth is low, but relatively speaking, it is not as low as it was in September. So September was a higher probability break than the February squeeze here. Sometimes the February squeeze, if you look back here, you can see that one had been going on for about a month or so, maybe more. And so this one was actually lower probability because the bandwidth was not as low. And that's what I was trying to say in the last video, where sometimes the bandwidth contracts, but it's not a squeeze. Here, it was kind of the same setup here. It was contracting, but it wasn't nearly as tight as the one in September. It did still play out, but it took a little bit more time. Look at what happened. We had our first close outside the bands. The next day, we had a solid close outside the band. Bandwidth starts to go up. You're extremely overbought now, and the bandwidth continues to go higher. And as you watch this bandwidth going higher, it's interesting because we traded sideways for 4 sessions before we got another bullish candle there. but the whole time the bandwidth was going higher, telling you the volatility is going up. And so there's still strength in this trade. And then eventually the surge came in here and eventually it gapped on out. And again, it became a pretty good profitable trade on First Solar here. So there's a couple more examples here. Now let me show you a head fake example on Halliburton. The scaling on this one's a little bit off. Just simply because we had about a 50% drop in the stock. If you come to the left side of the chart, you see very, very low bandwidth back here in September coming into October. And the bands had actually started to expand before we got the squeeze set up here. But you start to see the closes outside the band here. I don't have the %B on here, so you can't see that. But you still see the closes outside the band. And then once this move started moving, it was a $65 move down to about $50. So there's about $15 per share move. But that's not the one I wanted to show you. The one I wanted to show you is the head fake on the right side over here. You see the squeeze, you see the close outside the bands. Now notice the weakness that's in here. These are very small candles, so it's not really strong momentum at this point. You've also started to establish a base. If you look here, you can see we're establishing some support. And as we get back down to that level, we've got a bullish engulfing candle. It's just 4 days after we broke and closed below the band. And so when you see that right there, in this case it was exactly 4 days. Usually it's within 2 to 4 days, occasionally 5 days, but usually within 2 to 4 days, there's your head fake right there. You're starting to break bearish. Instead, it gave you a bullish engulfing formation. Buy the trade. You end up getting in to the stock about $40, maybe $41. You set your stop about $39. And so you got about $1.50 to $2 risk. And then your target up here became about $45. And in fact, the trade went a lot further than that. But that became a pretty good 2 or 3 to 1 risk reward trade. And most head fakes work out like this. So there's a couple of examples of both the squeezes and the head fake to kind of get you going in the right direction.